Let's be honest. Most people hear words like PE ratio, market cap, bull market, liquidity. And they just nod like they understand. But inside, total confusion. So today we're fixing that. No Wall Street jargon. No ego. Just stickman and real clarity. My name is Tito, and I spend way too much time thinking about how regular people can understand the stock market without feeling overwhelmed. If you want to invest but feel lost in the terminology, subscribe and give this video a thumbs up if it helps. Look, the stock market isn't complicated. It's just poorly explained. Let's break it down. Part 1. What is a stock? A stock is ownership. That's it. Imagine a company is a pizza. When you buy a stock, you own a slice. If the company grows, your slice becomes more valuable. If it shrinks, so does your slice. There are two main types, common stock and preferred stock. Common stock gives possible dividends and voting rights, while preferred stock usually offers steadier dividends but no voting. When you buy a stock, you're not buying a ticker symbol. You're buying a business. Part 2. The stock market and exchanges. The stock market is just a marketplace. Instead of buying fruit, you're buying ownership. Trades happen on exchanges like NYSE and NASDAQ. Prices move because of supply and demand. More buyers than sellers. Price goes up. More sellers than buyers. Price drops. Markets move on emotion as much as logic, fear, greed, FOMO. That's why prices swing. Part 3. Indexes, the market's report card. You'll hear about the S&P 500, Dow Jones, and NASDAQ. These are indexes. Think of them as report cards. The S&P 500 tracks 500 large U.S. companies. The Dow tracks 30 major companies. The NASDAQ composite is tech-heavy. If your portfolio rises 5% but the S&P 500 rises 10%, you underperformed. Indexes are benchmarks. They show you how the overall market is doing. Part 4. Bull versus bear markets. When markets rise consistently, that's a bull market, optimism, growth, confidence. When markets fall, that's a bear market, fear, panic selling. How long do they last? Years sometimes. Months sometimes. Markets move in cycles. They rise, they fall, they recover, they repeat. Smart investors prepare for both. Part 5. Key financial terms that actually matter. Market cap equals stock price times number of shares. Big market cap means large, stable companies. Small market cap means smaller, riskier companies. PE ratio shows how much investors pay for $1 of profit. High PE means high growth expectations. Low PE could be cheap or a warning sign. Dividend is a portion of profit paid to shareholders. Some companies pay you just for owning them. EPS means earnings per share. Profit divided by number of shares. Higher EPS often signals stronger performance. These numbers help you evaluate businesses, not just chase hype. Part 6. Orders and how trades work. When you buy a stock, you place an order. Market order buys instantly at current price. Limit order buys only at your chosen price. Volume is how many shares are traded. Liquidity is how easy it is to buy or sell. Bid and ask are buyer's price versus seller's price. The difference is the spread. This is just mechanics. Don't overcomplicate it. Part 7. Diversification, your safety belt. If volatility is the roller coaster, diversification is your seatbelt. Diversification means spreading money across multiple investments, not betting everything on one stock. Some people pick individual stocks, others invest in index funds or ETFs. Index funds track markets like the S&P 500. Instead of owning one company, you own hundreds. Historically, broad market indexes have averaged around 8 to 10% annually over long periods. Not guaranteed but powerful. Time in the market beats timing the market. Patience beats prediction. Part 8. Blue chips versus penny stocks. Blue chip stocks are large established companies, stable and reliable. Penny stocks are cheap small companies with high risk and high hype. Penny stocks feel exciting, blue chips feel boring, guess which usually builds wealth long term. Exactly. Final thoughts. The stock market isn't a casino, it's a system of ownership. The more you understand the terms, the less emotional you become, and emotional control is the real edge. Investing isn't a sprint, it's a marathon with a few scary hills. If this made stock market language make sense, comment which term clicked for you and I'll see you in the next one.